Hey trader, have you ever missed a great trade just because you didn't catch the trend reversal in time? Yeah, that happens a lot, and usually it's because traders overlook one key thing, the change of character or CHoCH. In this video, I'll show you how to spot it in both bullish and bearish markets, how to know if it's valid, and how to avoid those fakeouts that trap so many people. If you're looking to turn structure into smart entries, you're in the right place. Now that you've seen how professional traders approach this concept in practice, let's go back to the foundation. What are the basics of change of character? A change of character, or CHoCH, occurs when the dominant market momentum begins to fade, signaling a potential transition in trend and order flow. This shift often marks the moment when buyers lose control and sellers step in, or vice versa. Technically, it appears as a break in the most recent structure, suggesting that the market environment may be changing. Now, let's see how we can identify a valid change of character in the market. In a bearish scenario, a change of character takes place when the price breaks and closes below the most recent major low and the latest demand zone. The same concepts apply to a bullish scenario. For example, when the price was in an uptrend, consistently forming bullish structure breaks, a shift occurs when it breaks through the most recent major low in the demand zone, signifying the first change of character. The downward momentum continues as the price pushes through the next demand zone and higher low, resulting in a second change of character. This dual change of character suggests an impending shift in market structure. Now we can anticipate the price entering the bearish order flow. Consider this crucial point. Every time a zone breaks, an opposite side zone automatically forms. Since the price has broken several demand zones, a supply zone has been created at the extreme. Therefore, our expectation is for the price to push higher toward the extreme supply zone. If the price reacts to this zone, we can enter the market by placing sell positions. Our anticipation for the price is to form successive bearish breaks of structures to the downside. To fully grasp why these movements occur, it's essential to understand the psychology behind the change of character, or CHoCH. This involves recognizing the behavior of retail traders and institutions. Large players use these character changes to create false breakouts and capture retail traders' stop-loss orders. Retail traders tend to follow predictable patterns, placing their stop-loss orders at support and resistance levels. This happens because many traders use similar strategies based on classic technical analysis that indicates these points as key levels for loss protection. When a large number of stop-loss orders accumulate at a certain level, it creates a liquidity zone that can be exploited by the market's big players. These big players, or smart money, know that these points are vulnerable and can move the price to these liquidity zones to cause false breakouts, activating stop losses, and creating an opportunity to enter the market at a more favorable position. This kind of manipulation is exactly the kind of thing we talk about and show in detail throughout our Smart Money Concepts playlist here on the channel. If you haven't checked it out yet, I really recommend watching a few key videos. Start with Liquidity in Trading, the secret of pro traders revealed. It breaks down how the big players use liquidity zones to trap retail traders. Then there's Buy-Side Liquidity, BSL, and Sell-Side Liquidity, SSL, which shows how these zones are created and why they matter so much. And don't miss Inductions Explained, a guide to smart money manipulation and market traps. That one goes deep into how price is intentionally moved to mess with your emotions and get you into bad trades. So, if this topic interests you, go check out the playlist. Those videos will really help connect the dots and sharpen your edge in the market. Continuing with a practical example, if there is significant resistance on the chart, it is likely that many traders have their stop-loss orders just above this level. Smart money can push the price above this resistance to activate these orders, capture the liquidity, and then reverse the price direction. Understanding this dynamic can help us better interpret market movements. Looking at the chart, we notice that after the mitigation of the extreme demand zone attributed to the change of character or CHoCH wave, the price reversed its direction, pushed lower, broke through, and closed below the newly generated lower low. Subsequently, the price formed a pullback, rose back up, reacted to another supply zone, and then continued pushing down, breaking another structure. It is evident that the market's overall bullish structure has changed to bearish after the formation of the change of character pattern, and the price entered the bearish order flow phase. So a change of character involves changing the market's overall trend from bearish to bullish or from bullish to bearish. Let's consider another market structure where the price has formed a change of character by breaking and closing above a major high. Additionally, we see that the price breaks through this supply zone. It's noteworthy that the price has not left any unmitigated supply behind. As you can see, all the supply zones have been mitigated. This means that as the price breaks through the latest supply zone, it signifies the formation of a demand zone. As mentioned earlier, whenever a zone breaks, an opposite side zone is automatically formed. Therefore, a newly generated unmitigated demand zone emerges at the extreme. Considering this, entering a long position based on this demand zone is a viable option. There is a high probability that the price will return to this demand zone, react to it, and then change its direction to the upside. This expectation is supported by the prior formation of a bullish change of character, indicating an upcoming shift in the market structure towards a bullish trend. In this situation, the price has a great opportunity to retrace back down, touch our newly generated demand zone, activate our pending buy order, and then push to the upside. Now let's move into the essential criteria and rules we need to consider to identify valid and high-quality change of character, or CHoCH, patterns in the market and understand how we can use them to our advantage. The first criterion to identify a valid change of character, or CHoCH, is higher time frame mitigation. A CHoCH is valid only if the price reverses and originates from a higher time frame supply or demand zone before breaking the recent major structure and initiating the CHoCH. If the price creates a CHoCH without interacting with a supply or demand zone, even with a valid candlestick pattern, it cannot be considered a valid CHoCH. This is crucial because it helps us identify high probability points of interest and valid reversal patterns, preventing us from falling into traps caused by false reversals and trading in the wrong direction. For example, consider a bearish market structure where sellers are in control. The price has formed a series of bearish breaks of structure and supply zones associated with these structure breaks. In the following scenario, we see that the price moved upwards after indicating a tiny rejection from the last supply zone. The price broke and closed above it. Here, we are facing a common scenario that frequently occurs in the market. Many novice traders who haven't correctly identified the market structure often consider this upward movement as a CHoCH, a signal of a reversal in market direction. They believe that the bearish phase has ended and it's an ideal time to go long with the newly formed demand zone. They typically place their stop loss just below this new demand zone. However, contrary to their expectations, the price made a brief upward move, mitigated the upper supply, and then continued its bearish movement. This resulted in hitting the stop loss of traders who had taken long positions. They often failed to realize why their stop loss was triggered by the price, and unfortunately, they repeat these actions repeatedly. What they missed here is a crucial point. The price didn't reverse from any unmitigated demand zone. They shouldn't have entered a long position until the price reached a major unmitigated demand area. Their identified CHoCH was invalid, and the price only moved upwards to mitigate the upper supply zone. It used the last supply zone as an inducement zone to sweep more liquidity and gain more momentum to fuel its downward movement. This scenario highlights that without a proper understanding of market structure, you're likely to experience losses. Inexperienced traders could have avoided this if they had a better understanding of market sentiment. They would have noticed that their identified CHoCH was not valid because the price hadn't reached the higher time frame demand zone yet. Now let's move into the next confluence criterion for identifying CHoCHs with high probabilities, liquidity sweep. To obtain additional confirmation in identifying high-quality change of character patterns indicating an upcoming market structure shift, we should wait for the price to establish static liquidity zones near our identified higher time frame area of interest. We fully discussed static liquidity zones and their various types and models in the market in detail in our previous episodes. I strongly recommend watching those episodes carefully if you want to have a solid grasp of static liquidity zones and understand their profound impact on market price direction. However, let's have a quick breakdown of them here. As you know, static liquidity refers to the specific zones in the market where a large pool of money is resting, such as stop losses, buy or sell orders, and can also be found in various areas on the price chart. When we talk about static liquidity, there are a few patterns that show up all the time in the market, and they're super practical to spot. I'm talking about things like equal lows, equal highs, and dynamic trend lines. Each of these fits into some classic chart formations you've probably seen before, like double bottoms, double tops, sometimes even triple tops or bottoms, and of course those bullish or bearish trend lines that everyone draws. Now picture this, we're looking at a higher time frame, say the 15-minute chart. Price is clearly in a downtrend and you can see it breaking structure to the downside again and again, forming those BOS, breaks of structure. After tapping into the previous supply zone, the price reversed and created an unmitigated supply zone awaiting mitigation. Now the price is pushing to the upside. Zooming into a lower time frame, like the 1-minute time frame, we see that the price has formed a series of higher highs and higher lows on its path toward the 15-minute time frame supply zone. Just before tapping into the supply zone and right below it, the price created equal highs, forming a double top that accumulates great liquidity near our identified higher time frame supply zone. We see that the price sweeps the liquidity accumulated above the double tops, taps into the higher time frame supply zone, reverses its direction after mitigating the 15-minute supply zone, pushes downward, and creates a change of character by breaking and closing below the most recent major low, eventually breaking through this demand zone formed by the break of structure. As mentioned earlier, every time a zone breaks, an opposite side zone automatically forms. Since the price broke through the latest bullish demand zone, it has formed a supply zone right here, associated with the change of character's bearish wave. So, here we have the confluence factors that we were looking for to identify a high-quality change of character pattern that provides a high probability in the market. After mitigating the higher timeframe supply zone and conducting a liquidity sweep in the current timeframe, a change of character formation occurs. In the next step, we can place a sell limit order at the lowest point of the newly generated supply zone, setting the stop loss a few pips above the highest point of the zone. For the take profit, we can either set it at the unmitigated demand zone of the higher timeframe or target the current timeframe swing low. Recognizing a liquidity sweep pattern before the price reaches our identified area of interest is crucial. This pattern confirms the strength of our supply-demand area. We use liquidity sweeps as a confirmation factor. The idea is simple. The market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. As a result, if the price taps into a higher time frame supply or demand zone without sweeping liquidity and subsequently shows a rejection, then also creates a change of character pattern on the lower time frame, there is a high chance that the price will continue moving in the opposite direction of the newly generated change of character. This can also trigger stop losses of traders who entered the market expecting that the price would change its primary direction after the emergence of the change of character pattern. Now, let's proceed to the next criterion, which is the double zone breakout. For a change of character, or CHoCH, pattern to be more effective with a higher chance of success, the price should break and close below or above two successive supply or demand zones along its path. For example, in this scenario, if the price breaks through this demand zone, we have a double zone breakout because the price breaks out of two successive demand zones with a bearish single leg movement. This pattern will be a strong confluence and confirmation for entering the market by opening short or long positions, depending on the bearish or bullish order flow. Let's consider a scenario where the price only created this supply zone. The price broke through and closed below the two demand zones, leaving a significant inefficiency behind. This provides a strong confirmation after the emergence of the double zone breakout. Subsequently, a newly generated strong supply zone forms at the extreme. In this case, we can place a sell limit order at the extreme demand zone because the price has a great chance to return, fill the inefficiency left, fulfill the orders, tap into the order block, mitigate the supply zone, and then push to the downside. Considering the concept of a double zone breakout or even multiple zone breakouts in your trading will enhance your confidence in your trading journey, making you more certain about your trades. Now let's explore another possible scenario of a double zone breakout that you might frequently encounter in the market. Once again, we have the same scenario with only one difference. The price couldn't break through the second demand zone with a single downside movement. We see that the price broke through the last demand zone and created this supply zone at the extreme. Then the price experienced a temporary pause and a pullback, but it couldn't mitigate the extreme supply zone. Instead, it formed a liquidity pool by creating a double top. Subsequently, the price pushed to the downside and broke out of the next demand zone. Since a demand zone has been broken, a new opposite side zone will be created, which is this supply zone. As mentioned earlier, the upper supply zone is the extreme one, and the second supply zone, located a bit lower, is called the decisional zone. Please consider that we cannot place any trades based on the decisional supply zone because there is a high chance that the price will push higher to sweep the liquidity accumulated above the double tops and trigger the stop loss of traders who entered from the decisional supply zone. If you had entered the market from the decisional supply zone, there is a high chance that the price will push higher to mitigate the extreme zone and also sweep the liquidity accumulated along its way. If you had an order, you would be part of that liquidity. What we should do is wait for the price to sweep the liquidity accumulated in the market, tap into our extreme supply zone, and then we can enter the market. To wrap up, mastering the concept of change of character is essential if you want to stay ahead of market shifts and avoid getting caught in traps. Throughout this video, we've explored how to identify CHoCH patterns and why elements like higher time frame mitigation, liquidity sweeps, and double zone breakouts can make the difference between a fake out and a real opportunity. But beyond recognizing patterns, it's about building a solid foundation, focusing on one strategy, one market, and executing with consistency. And that's exactly the kind of mindset Dan Gramza brings in the clip below.
I guess my feeling is for someone starting out, that they pick something that they feel comfortable with from the concept point of view. If the idea of stock investment feels comfortable to them, I would stick with that. I wouldn't do both at the same time. Or futures, if they like the idea of maximizing their capital. If they're comfortable with the idea that there's an expiration. Some of the issues, because there are different investments. And some people say this is better than that. It's not true, in my opinion. They're not better, they're different. So it's important, either one, that we understand what those investments are. And whatever our interest is in, then I think that's the direction you should go, but not both at once. And also not to trade the entire stock market at once either, because that feels overwhelming. Same thing in the futures. I see so many people who want to trade the futures markets. And what do you trade? Currencies, indexes, all these different markets they can look at, and they feel overwhelmed. So I think it's important to narrow that choice. When I started in the options exchange in Chicago. Then I went over to the Board of Trade. And what I did there is I picked one market. Now, at that time, it happened to be the U.S. Treasury bonds. That was the hot market. But I understood every nook and cranny of how that market moved with respect to my strategy. Not only does it limit some of the feeling of being overwhelmed, but it also allows a foundation to be put in place. So that now if you and I understand this market well with our strategy, when it works, when it doesn't work, how much risk, how much profit, how much time to give that trade, then I can relate that to other markets. So if you and I want to trade stock indexes, because we find that interesting, then I can relate that to currencies. How do they trade that's similar? How do they trade that's different? And if I understand that first market well, I'd say, oh yeah, here, this doesn't do that at that time. Or this is very aggressive at this time. So it allows me to use that as a reference to other markets that I want to trade. So that's why I feel it's important to narrow that choice, take our time, and treat it truly as a business. My equity run is my production report, is the way I look at it. I think the last component, Tom, that I think is important is not to take it personally. There is no personal connection to the market. The market is a perfect trading partner. It doesn't say, oh my God, you're back here again. I can't believe you're going to do that again. And you're going to buy? Oh my, it doesn't do that, as we both know. What it does is it's there to be there for us. It'll take the other side of our trade. Our inventory always stays liquid that way. So I think it's important that people do not take it personally, that they look at that and say, did I make the right decision? Did I follow my strategy? If I did, good job. Am I going to have losses? Absolutely. Am I going to have profitable trades? Well, we should if we were following our strategy correctly.
This perspective ties everything together. It's not just about reading the chart, it's about reading yourself, your strategy, and the market as one system. CHoCH is part of that process. It's a signal, but the edge comes from how you respond to it. We hope this video helped clarify the power of change of character. Thanks for watching, and remember to check out the other videos in our Smart Money Concepts playlist.
I hope you enjoyed today's video. If you found the content useful or fun, please give it a like, as this helps the video reach more traders like you. Remember to subscribe to the channel and activate notifications to stay updated with the latest financial market information and trading tips. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Your support allows us to continue bringing high-quality content, helping you make more informed decisions in the markets. Thank you for watching and good luck on achieving excellent results in your trades.